Welcome to another video here. So I just saw something very interesting in volatility 50. I might have missed the move, but it's a very good case study. So I want to show you guys so that any other time if you see the markets reprinting something similar like this, you know how to navigate through. Now this is volatility 50, and what we have here, let me zoom in a bit. What we have here is this relative equal highs here. So something like this, fine. Price action like this very clean highs, too clean, and then relatively equal to this one. So this is equal highs, relatively equal to this, and all of those sum up and make up your buy side liquidity. So from the numeracy perspective, people will be looking at those levels as rejection level where market has been finding it difficult to break through. So there will be a lot of short sellers there. Above that level, there will be a lot of buy traders who believe it's a breakout and market is going to retrace and continue. This setup was very interesting, so I could not even let it slide even if I actually did not trade it. I was following it up a bit, but then I missed it because I got busy. Now let's study it hypothetically together and see what we can deduce from it. Now, this is the buy side liquidity. These clean levels here, very clean. So we anticipate market to take out that level. Market does not leave levels as clean as this without running through them. Now, price trades to the buy side liquidity with this price action here, and trades above it, taking out the buy side liquidity, resting above here, took out the buy side liquidity, and then price drop. Now this is where it got interesting. Price came back up and failed to trade above this high. So this becomes a swing failure. This way, this high to this high becomes a swing failure. No problems. But after the swing failure, what did happen? Look at this low here. This actually is an intermediate term low. The reason is because it's a low that formed from rebalancing a fair value gap. So this is an intermediate term low formed below the buy side liquidity, which was taken out, and then a swing failure above the intermediate term low. After that, what happened? Look at markets drop and take out the intermediate term low. I'm going to drop to lower time frame for us to add more emphasis to this price action. Now, prior to the market dropping, look at this candle. Can you see this impulse? Look at this one. There was this too impulsive candle and market swung back up. The bullishness was weak, and another impulsive sell candle. So this is like the ICT's illustration of talking about elephant getting into a pool and causing displacement. So you can see the displacement in the price. The price is running speedily from a specific zone. Price is being displaced. So this is like water expanding away from the pool because a big elephant got into the pool. I look at it. So we swung up and failed to violate this high, making it a swing failure. And we dropped back into this low, this intermediate term low here formed by rebalancing this fair value gap. And what happened? We took out that intermediate term low. Now, whenever we take out intermediate term low, what does it mean? It becomes a significant change in market structure. So the probability for market to reverse are very likely. So after saying something like this, what do you go for? What do you do? Check the displacement leg, which is from this swing high to this swing low. Is there anything within that leg that will trigger you to becoming bearish in the market? So yes, there is. Look at this displacement candle created this big fair value gap. Now let's assume you're not going to be dissecting and studying the price just from the 1 hour, and you drop to 15 minutes. So we have a smaller region of the fair value gap there. So this is the whole displacement leg. You can see price displacing this intermediate term low, this 1 hour intermediate term low. This is it in the 15 minutes. Look at the whole displacement. And here, the fair value gap. And what exactly did price do? After displacing the intermediate term low, price reversed and came back to rebalance the fair value gap, and what else? Started selling. Now, in cases like this, where will you be targeting? How will you make your entries? Now, first, for you to make your entries, Once price come back to this zone, since we've narrowed down the fair value gap, once price come back to the fair value gap zone, the first thing you want to look out for is reaction away from the fair value gap. Or if you're not going to be going for extra layers of confirmation, then your stop and your entry is just going to be as simple as this. Your entry is here, just as price triggered this high of this candle. Once price reverse back to that level, that will be your entry. And what will be your stop? The high of the fair value gap candle. Give it some space, or use the overall swing high in the zone, which is here. So either here for an aggressive entry, or here for a conservative entry. So if you're not worried about being wrong, you can use this. If you want to use big lot size and small stops for it to still be cheap, you can use the high of the fair value gap candle. Otherwise, you focus on the major swing high in the zone. Fine. So if you want to go for extra layer of confirmation, go to the next step. If you don't want to, just trigger yourself in, put a limit entry here, and once it gets triggered, that's it, you're in the position. But if you want to go for extra layer of confirmation and even reduce your risk even more, you drop into lower time frame again. Now this is the point where price traded into the fair value gap. If you want to go for confirmation entry, then you should be waiting. You should be waiting for reaction before you go in. So this is the point of the fair value gap. And what do we have? Price started trading away from the fair value gap. So now you are sure that yes, the fair value gap is reacting. Now you look for an entry model that suits you. So it can be, maybe you trade breaker blocks, or you trade other blocks, or you trade fair value gaps. Now specifically, I still focus on using gaps to enter, inefficiencies to enter. So in that case, I'll be focusing on looking at any fair value gap market will come back to rebalance, and using it to trigger myself into the position. Now this could have been a hypothetical entry using gaps here to here. These three candles, one, two, three. You can see the disconnection in between those three candles. Fine. That's exactly the fair value gap. 1, 2, 3 candles. Candle number 1, candle number 2, candle number 3. And then there is the disconnection in between the low of this candle and the high of this candle. That becomes your fair value gap. This is for a confirmation entry. And after the fair value gap, what did price do? Came back to rebalance the fair value gap, trading it back to this low of this candle, closing up the fair value gap, and started selling. So this could be your entry if you are going for a confirmation entry. So you wait for reaction away from the initial fair value gap and wait for another fair value gap, or any other entry model, be it OTE, retracement, or other block for you to go in. But keep it simple. If you wish to, just focus on using fair value gaps, because this is very close to the 2022 ICT model that it taught. This actually is part of it, utilizing it. So take out buy side liquidity, displace to the downside, taking out an intermediate term low, which will signify a significant change in market structure. So this is not like market giving you higher highs and higher lows and then lower low for you to say that's a change in market structure. That's just a regular breaking short-term highs or short-term low. But what we have here is a violation of an intermediate term low, which is very significant in the marketplace. And from all of this, you can see like the whole reaction, we came back to the displacement range, trade into fair value gap, and this whole price leg. So I hope this video was informative to you and you understand the model. So when you go into your charts, when you spot something like this, I'm sure you'll be able to know how to execute. Thank you for watching. See you in the next video.